All right, guys, welcome to the August 2025 Economic and Housing Update, State of the Market Update for Sarasota, Charlotte, and Manatee counties. So I appreciate you guys being here today. As always, we do these calls to be able to help inform you on what's happening behind the scenes. And Chris and I, Chris, my trusty co-host on this call now. Say hi, Chris.
Hey guys, how you doing? Welcome
There,
to the call. Thanks
there you
for the
go.
introduction.
We do the geeky work behind the scenes of reading the articles, studying the trends, looking at the charts, all these other things so that you don't have to, and you can very simply just be able to listen to the takeaways, go rewatch this and utilize these tools in your database, in your listing presentations, wherever you are talking with your customers. And Gary, of course, challenges us all to be the local economist of choice in the Red Book. And so that's part of what we're doing here. So I'm Brian Wentz. I'm the operating principal for KW Coastal Living 1 and 2. And Chris, do you want to introduce yourself?
Yeah, I'm loan officer with Echelon Home Loans in-house to the KW Coastal Living Collection and also independent mortgage brokerage.
Yep, that's great. Chris is our finance guy that can help all of your clients with any of their loan needs that they have. So we're going to dive in. So we've got a lot going on, and I would say that I feel like I always say this, but there's a lot happening, and it's been a really wild ride this last 30 days. So the last time that we met, the Fed Chairman Powell was actually going to be speaking at the Jackson Hole event, and we had a jobs report that was coming out. I believe it was 2 days after our last call on August 31st. I'm sorry, July 31st. Wow, did things change fast? Would you agree, Chris?
I would say that, I mean, it was kind of an unexpected report, although I think we were feeling it. It finally showed its head. It finally reared its head there, yeah.
Yeah, so we'll talk a little bit about what that means. So to just give you a little bit of an idea of what has actually happened since we last met, the good news is mortgage rates, they've actually gone lower. So we've got some rates we haven't seen in a little while, and that's going to be positive. And we're going to talk about why that's happening and how to take advantage of that. We unfortunately still have spreads that are still elevated. And if you don't know what a spread is, it's okay. It's not butter. It's not, something you put on your toast. We'll talk a little bit about that, but we're still seeing the spreads a little high. We've had some inflation data that came out, and today I actually got a question after the call. I think it was a call or two ago that they asked the question, which inflation data were you talking about? And that was a great question. So we're gonna spend a little time on that and how to understand which number matters, because they mean different things. There's a couple different numbers. The good news is we had the labor market report came out. We're going to talk a little bit about that. To put it bluntly, the labor had looked good, had almost been like head scratchingly good. And then all of a sudden they went, whoops, we made a really big mistake. And the jobs report that came out at the first of the month was brutal. And they also revised the last 2 months downward, which made those good months that were head scratchers kind of look like, oh, that's maybe a little more realistic. So we'll talk about that and how that's impacting the financial markets. That did lead to Powell starting to signal that rate cuts are potentially ahead. And there's some mixed signals on this because, of course, he's been in a pretty high-profile brouhaha with Trump, and they've had some back and forths and some jabs, and they've been kind of. There's a great meme of them, the two of them, kung fu fighting that's out on Instagram. So it's been an interesting challenge. We're still talking about the shadow Fed potentially. Fed Powell's term is up is it June of next year, Chris?
May or June of next year,
It's
yeah.
May or June, yeah. So he's entrenched right now, and yet if the Trump administration announces who's going to be next, who's going to be a successor, that person kind of becomes the talking head. And even though it doesn't replace Jerome Powell, that voice would become louder, and the markets would listen to that voice of what's going to happen ahead. Now, the funny part on that is that I shouldn't say it's funny. just last night while Chris and I were prepping, we have one of the Fed governors that got involved in a mortgage fraud case, and Trump did kind of boot that individual out. Probably remains to be seen whether there's going to be some kind of a litigation or judicial action to try to prevent that from happening. However, that also allows him to start to put people in that he wants to be on teen lower rates, which is what the Trump administration wants for a couple of different reasons. Got a little bit of an update on builder confidence, which keeps going down, and that's really important because that also connects with the labor data that we're going to talk about. And we've got a little bit of existing home sales that we're going to go through. So that's really in a nutshell, what we've been dealing with. If we look at 30-year fixed rates, Chris, do you want to talk to us about rates?
Yeah, we're sitting in the average right now. Today's national average. And just so you guys know, when you guys ask me for interest rates and you're looking for like what's today's rate, I use a website called Mortgage News Daily, and it's actually an application. And on there, it'll give me the averages for VA, for jumbo, for adjustable, and also for conventional. And so today's rates are sitting at about 6.5% as a national average. And so we've hit our lowest for the year, I think is what Logan said. We've hit our lowest rates for the year, and it's trending downward. That's for sure.
Yeah. Yeah. So rate 6.5, 6.6 range. That's been the lowest level since October of 24. What's important about that is we're right on the magical line where when we get in that 6 to 6.4, and especially if we can stay there for about 10 to 12 weeks, you're going to find that is when we see mortgage purchase application demand go up, and that's also when we see a bump in the seasonally adjusted existing home sales. So we're really close, and what's going to happen in the next 30 days is really going to give us a lot of indicator as to what direction the year is going to go, because it still can go both directions. The unfortunate part is the spreads remain high. If we could get back to some normal spreads, we'd be in the high fives, mid fives right now. And that's really important because as some of the tariff talk and some of the other things settle into the market, we're positioned to see a really, really good market ahead. And when you think about it in terms of the fact that the last 3 years, we've had anywhere from about 1.2 to 1.7 million transactions that should have occurred that did not. We've got, and we've talked about this on past calls, but we've got an entire year's worth of transactions that are kind of, I don't like the pent up demand conversation, but that's kind of what it is. It's people that had life events that will have a need to do something, and that's going to trickle in and really drive those sales eventually. So a little bit of a look at 30-year, 15-year FHA, VA. Anything you want to add to this slide, Chris?
Yeah, so something I want to talk about is today the average 30-year fix, like I said, is about 6.5. Call it, whatever stat you're looking at it from. This time last year, it was 6.43%. But we got to remember something. What happened last year in the August-September timeframe? We had a rate cut, right? We had coming around this time. The 10-year Treasury today is at like 4.26, and we're sitting at a 6.5 rate. This time last year, it was at 3.81. And why that's important is we are near what we were last year, and our 10-year is much higher than it was before, and that's the improvement in the spreads. So while we can't guarantee that when we have a rate cut, rates will go down, we hope that it'll happen. And one aspect of it, it could go the other way too, right? It doesn't guarantee that mortgage rates will go down yet, as well, but mortgage spreads have been a really blessing. And one of the economists that we follow, Logan, said, hug your mortgage spreads today, because all the action that we had with the Fed and this Cook member and all the things happening, nothing's really playing out in the markets.
Yeah, because we could be closer to like 7.75, somewhere in that neighborhood, if we were at the worst of the spreads in the last couple of years.
Yeah.
So
yeah.
yeah, so let's break this down. This is the 1 year, 30-year fixed rate mortgage. So you can kind of see where things go up and down, and you can see where economics really drive the variability in this. So you can see back in April when we had Liberation Day, the tariffs were announced, drove the markets into a frenzy, and you saw rates go up. You can kind of see they're making that gradual move back down. And September last year, we did have two rate cuts. The market is starting to price in some rate cuts into the future, and we'll talk a little bit about that. And yet last year when we had the rate cuts, rates actually ended up going up, which was unusual. Okay. So here's just a few talking points when people say, hey, what are rates doing? Rates are still in the mid sixes, but it's a lot lower than a few months ago. Every drop adds to your buying power. So getting in now lets you own the home you want with negotiation power. And when rates ease, you can refinance and lower your payment later. So that's the date the rate, marry the house concept.
And I want to add something to that too, guys.
Yeah.
We're so fixated on this call talking about interest rates. And I know that's what a lot of people are talking about, especially your buyers. I want this rate. I want this rate. Those people don't understand why that's important to them, though. And, if we're having conversations with clients out there that are talking about rates, return that conversation into what's a comfortable monthly payment for you, right? Because if the monthly payment is $2,000, and I'm going to say this lightly, who cares what the rate is, as long as it's within your budget, it's kind of a real way to structure that conversation away from the rate conscientious person that might be shopping you for reasons they don't really understand. It's just everybody's talking about it, and bring them back in a different way and say, hey, listen, we're looking for an optimized monthly payment for you. What's your maximum budget in a payment? Because the rate, again, could be 8%, could be 6%. What's the payment that we're looking for, and back into it that way to try to get sales driving today still. Yeah.
Yeah, it's a great point.
Yeah.
Quick script for sellers. Rates aren't crashing, but they've eased just enough to bring buyers back off the sidelines. So listing now lets you capture today's motivated buyer before more inventory comes back in the market. Okay. We're going to talk a little bit about inventory trends. So as Chris alluded to, we're sitting at about 4.19%. All that really means is there's a cost of money, and this is what when the mortgage company is looking at what it costs them to acquire money and then lend it to us. The 10-year Treasury is the benchmark. The spread is kind of the extra margin or the gap that's between whatever the mortgage rate is and what they pay for the money. So we've been in this 4.2, 4.26 right now. It looks like the market's probably pricing in two rate cuts still for 2025. So that would be September and December. Is that correct, Chris?
Yeah, I think that's what I saw on the chart as well.
Yeah, so September, December. It looks like the odds are pretty high. I think it was 85% odds of two rate cuts with a total of 50 bips, which is each 25 bips is just a half of a percent. So that has the ability to bring rates down. Just knowing that Fed Powell, his word said, hey, it's probably going to be time for us to pivot. And we're going to go through his commentary in a moment. But that has enough of an impact that it can actually move the market, and rates can fall before they actually cut interest rates. So we're probably seeing a little bit of that rate cut starting to factor in. So if we just look at this on the chart, this has been the last year of the 10-year Treasury, and this is the really key item that's tied to mortgage rates. And we're going to talk a little bit about how that spread happens. And Chris, we talk a lot about this because I think it's something a lot of people don't understand. I think our consumers hear the Fed cut rates and they think that that's what causes mortgage rates to come down, but that's not quite the case, is it?
No, they're correlated. So the Fed cutting rates is the short-term overnight borrowing rate, and it's not a direct impact on the mortgage rates, but they correlate, right? So and I said that earlier that just because they cut rates doesn't mean that rates will go down, right? We saw that last year. We saw them cut rates, and then rates flew back up again. So there's a lot of other factors that go into it. So again, educating your clients to say like, this rate cut doesn't mean lower rates. It can mean lower rates, and it probably will mean lower rates. But just like last year when they did this, we still touched on a peak again, right? So again, trying to chase the bottom. You don't want to ever try to chase the bottom. You want to get along the ride along the way, and just navigating back off of that. This isn't really about the specific rate. It's about what a comfortable monthly payment is for you.
Yep. And to kind of illustrate this, we've got this graph that I've shown a few times over the last calls. This gray line is actually the federal funds rate. And you'll notice that in 2022, it started jumping. Of course, we all remember it was the fastest It was the fastest increase in the federal funds rate since 1980. So we shot up fast. And you can see where that impact got felt by the 10-year Treasury, which is the red line here. And you can kind of see how the red line and the blue line is actually mortgage rates. We call that the slow dance. They just kind of move at the same pace. Now, what you'll notice is back here in like 2021, you'll notice the line is pretty close together. That meant the spreads were pretty close, and 1.7 is historically the average spread. So when we're at a 1.7% spread between the 10-year and the 30-year, that means the market kind of knows what's coming. It means labor data is good. It means inflation's good. It's just like, hey, everything's kosher. The more things get not kosher, the greater the spreads, because you may have market volatility, there could be refinance risk and what have you. And you notice here, you can kind of see these spreads have gotten pretty big through a period of this time.
And let's take a moment there, right? We talk about these spreads and why is it important, right? As a mortgage company, not as like an individual like myself, they're a for profit, right? And when they do hundreds upon hundreds of loans, they want to make sure they stay in the money. If they start offering things that are too high versus the rates, they lose business to refinances. In the same way, if they're too low, then selling them, they may have an issue with that as well down the line. So as a mortgage lender, these spreads are important and they're pretty much synonymous around most lenders. I mean, you could always find some place in the middle of nowhere that'll have a better rate. There's always going to be someone with a better rate, but it's important to know why these spreads exist and why the mortgage companies exist this way, because they want to make money on their products. And they also don't want to lose money either.
Yep, it's a balancing act.
It is.
So if we look at where we are currently, the 10-year Treasury yesterday was 4.28, the 30-year was 6.54. So that spread means it was 2.3. So a little higher, not the 3 that we had been. So if you think about that, you could be 7.25 if spreads were at their worst based on yesterday's rates. But that spread reflects the market volatility, prepayment risk, and right now there's a little bit of a low demand for mortgaged securities, and part of that has to do with something that the government is actually doing right now. So here are some of the variables that would need to happen for those spreads to get back. One, the Treasury would need to begin buying mortgage-backed securities. We've been going through this really technical term, geeky term called quantitative easing. I'm sorry, quantitative tightening. The quantitative tightening means the Fed bought a whole bunch of stuff to spur activity in the marketplace, and now they're kind of getting that stuff off their balance sheet. So they're selling off mortgage-backed securities, which means there's fewer buyers of them, and that's impacting their comfortability on the spreads. You couple that with a little bit of weaker demand on Wall Street, there's a big concern that with rates having been so low and then so high, that when those rates come back down, we're going to have this massive refinance event happening. And the refis can really change the dynamics of those securities that are packaged together. And so because they can't see what's ahead, they just need more comfortability to be able to say, hey, this is what I see coming. The investors fear the early refis, and then just housing credit stabilizes and delinquencies stay low, which means that we don't get any major events when there's a fear of delinquencies. That's when you see the spreads go up. And for the most part, we're doing well on this, although we are starting to see a little bit of a crack in some of the early notices that lead to foreclosure. So we'll keep an eye on that closely. Here you can kind of see what happened this last month. This is that 30-year note just on a 30-day trend. And you can see when the jobs report was released August 1st, you can just see how that dropped like a rock. And this is literally how much mortgage rates and the 10-year Treasury hangs on every report, everything the Fed says. It all factors in, and the bond traders, they react accordingly.
And these swings are becoming less and less, though. If this would have happened last year, it would have been a larger swing back and forth. We'd have seen, higher peaks and valleys throughout this. The line that we're seeing, if we were to go back into like a 3-month window, is trending downward, even with the peaks and valleys. It's heading in that down direction, which is what we want to see.
Yeah, and with as much that's happened the last 2 or 3 weeks, rates have been really consistent. They haven't been all over the board.
Right.
Okay. Um, if you need some talking points, here's a couple of them. Rates feel high, but you're also shopping in a market with more options than we've seen in years. That means fewer bidding wars, more negotiating room, and sellers willing to offer incentives. You win on choice and terms, and you can refinance when rates ease. And then we've got, as it relates to the seller, even with a softer market, buyers still have jobs, they still have income, they're motivated to lock something in while rates ease. What matters for you is your positioning. So price it right, hit the market now. We'll be attracting qualified buyers before inventory builds and your competition increases. So just some positioning scripts. Employment. This was our market mover that happened this last month. June, the payrolls report came in, non-farm payrolls came in at 147,000. A lot of that was government hires. And I think it's important. There's a lot of conversation around, are these numbers faked? What do they do? And the reality is the way that they do the survey on this, it's just not a super precise process. And sometimes people don't respond, or when they do respond, it's a month or two later. And that's why you see the revision. So when July rolled around and they got the revisions, they brought the July number down to only 73,000 private sector jobs created. They were expecting 175,000. In May and June got reversed downward by another 258,000. That means the labor market, it's not breaking, but it is soft. Now, the Fed has two mandates. They want to look for stable employment and stable inflation, and they want to keep typically unemployment at around 4%, and you want to see inflation around 2%. When you see the jobs market reacting like this, even with, and this is probably the challenge the Fed has right now, is even with inflation a little higher, this jobs number, they're going to lean a little bit more on the jobs number, because if the labor markets start to break, that's what can push us into a recession, and they don't want that. So they're just kind of like trying to balance the two. As I said, that sent a little bit of a shockwave through the economy, and the 10-year dropped. And what's also important to note is that slowing employment does take some pressure off inflation, because when you're in a really, really hot job market, you've got to be really competitive with job offers to offer to potential employees. When you've got higher unemployment, you don't have to be so competitive, and that what you pay people actually starts to work into the inflationary numbers. So this is what it looked like going into July, and keep your eye on May and June. This is what it looked like after the revisions. You can see that was a major change, and you can see now we're 3, 4, 5 months into a softening job market, really going all the way back to December, January, February. Okay. Now, we've got this pesky thing called inflation, and inflation is just that concept that everything gets more expensive every year. And the question is, does it go too fast to where we get hyperinflation, or does it just kind of keep up? And if you think about it this way, the government, they really want to see wages growing at about 4% a year. They don't really look at real estate, but they want to see appreciation in that 2, 3, 4% a year in terms of the resale market. And they're looking to keep inflation at that 2%. So the question that we had was, which inflation number are you talking about? And I just want to define a couple things for you. And I don't expect you guys to remember this, but when we use these terms, it's sometimes good to have a little perspective. So we have the CPI, which is the Consumer Price Index. And this just tracks an average price change for this basket of goods. So anything that you use in a house, like that goes into your household expenses, they're just tracking that to say, how much did everything go up collectively. The challenge with that is that energy and food can be something that fluctuates really wildly. So to take out the sort of the wild card in that, we have a second number that we look at called core CPI, and core CPI removes those more volatile items. And the Fed watches this closely because food and energy go up and go down. Everything else tends to go up and never comes back down. And so they want to make sure that that core CPI, that stickiness doesn't stick. And then the last thing that we have is the producer's price index. And this is what businesses pay for goods and imports. And that becomes a leading indicator for what we all pay when we go to the store. And this is why the tariffs matter. We've talked a lot about tariffs the last couple of months, but as those 20, 30, 40% tariffs start to impact the import markets, somebody's paying for that. Now, currently, it looks like a lot of the suppliers and the supply chains are absorbing a lot of that because we're not seeing a lot of it coming into the inflationary numbers, but we are starting to see some of it. So this is probably the wild card for the next, what, Chris, you'd say 3 to 5 months?
It can go a lot of different ways. I mean, we just had the most recent report that showed inflation rose, right? And luckily, that didn't really tremble the markets too much. But this is that tap dance that the Fed's going to have right now is like, what's going to happen here? Is inflation going to rise? Are we going to lose some jobs? So, cutting rates could go either way, right? If inflation is not being handled, you shouldn't cut rates, you'd say, right? You argue that. So curious to see what's going to happen in the next 3 to 5 months. And that's why I continue to press on, when's the right time to buy? Well, when you can afford a monthly payment and what you're trying to buy, like that's when you can afford it. And so now could be the right time for a lot of people, not later, because it could be worse.
Yeah, spot on. Spot on. So when we look at inflation, the CPI, so the full basket of everything was 2.7. The core CPI was 3.1. So we want to see these numbers closer to 2, and this is this is what the Fed watches very closely. This is part of the reason why I say this literally and figuratively. The Fed does not care about housing. They care about if job or if new construction starts stop happening and we start to see the construction labor market break. They do care about that, but as it relates to housing itself, that's not something that's in their mandate. So one item that we know is buried in this core CPI is that rents this year for renewals for new leases for multifamily and single family properties, rents have fallen. And we actually see this even in some of our Florida numbers that I'm going to go over later. That data lags anywhere from a year to 18 months. And so I think we're going to see the tariffs probably increase that number a little bit, but you're going to see it drop back down with cheaper rents. So it'd be kind of interesting to see where that goes. And the producer price index was 3.3, which is a little bit high. And again, that reflects some tariff pressure. If we just look at the last year inflation, pretty consistently in that 2.5%, 3% range, a little higher than what the Fed likes to see. But if we look at it, well, let me show this one first. This is your consumer price index. This is that sense that everything gets more expensive every year. And you can kind of see from that 2015 to 2020 timeframe, like we went up, but not at a massive pace. What we're all feeling, the price of chips, the price of a car, all these other things has skyrocketed a lot over this last 4 or 5 years. And so you can kind of see where that 2021 acceleration has driven us. And it's, we feel it, the consumers feel it. Now, here's the other side of this though. If we take that same chart and we take food and energy out of it, this is the direction the core inflation is running, the core CPI. And you can kind of see again, this one gives you a really good sense that things were a little bit hunky-dory until COVID hit, things went crazy. We put a lot of money into the markets. That created a frenzy or a frothiness to the market, and all of our costs went up. So you can see we're headed in the right direction. And again, the Fed watches this very closely. So I think that, depending on what happens with tariffs, we're still headed in the right direction. which brings us to unemployment. Unemployment just defines what percentage of the labor force is officially unemployed. These are people that are exiting a job and they are now looking for a job. Currently, we're sitting at 4.2%, and actually that's a little bit low by historical standards. However, it's been creeping up. And there's some signals that the job market is starting to cool. Now, ongoing jobless claims has been pretty steady, but on new unemployment, first-time unemployment is starting to creep up. So we'll watch that closely and see. And again, it's employment and inflation, and as our kind of our guru that we follow says, it's labor over inflation. Paper rock scissors. Typically, they're going to look a little bit more at labor even over inflation. That's why I think we're going to see at least 1 to 2 cuts. Would you agree, Chris?
I would agree. The continuing jobless claims are staying elevated. The initial ones are staying low, which means that if you lose your job, it's harder to find a job again, right? And where all these statistics are year over year, month over month stuff, and it's just a perplexing to me that we still sit in that kind of environment where we're not really doing more of a future view of things.
True. That's true. You can see where that unemployment rate is trending, and you can kind of see where since like late 2022, 2023, you can see it's starting to rise and get a little higher. Initial jobless claims, we talked a little bit about that, tells us who's getting laid off, and that comes out every Thursday. It was currently 218,000 in July, the last report. So that's pretty stable number, not high, not low. And if you look at this over the last year, you get a little bit of a sense of where those initial jobless claims. There's a lot of seasonality in this because there are construction in some parts of the country are very seasonal. We don't have that here in Florida, but when it's cold, you start fewer homes, you dig less basements and what have you. So if we look at this though on the 5-year, you get a really good sense of the economy is still strong. It's still chugging along. It's resilient despite all of the other things that have happened. We're still in a good place. It's just that housing has been in a recession for the last 3 calendar years, and we're bouncing off of. For those of you that have been on our last calls, we're bouncing off the lowest sales pace for single family resale properties in history. Last year was the worst year since 1995. However, we've had 72 million population growth through legal population. That's not counting anything else. We had 72 million population growth that we know about. And that means that given our housing stock and the number of transactions, that means that compared to the population, last year was the worst year in history for housing. So if it feels hard, it's because it is. And
It is.
we feel it, mortgage loan originators feel it, consumers feel it, agents feel it. It's just, we're in a tough time. When you look at this, you can see this is part of what they're looking at also is building permits and new construction. These are both single family new construction and multifamily, which is 5 unit and greater. Building permits are at recessionary lows. So the builders are they're very cautious. Now, the builders are not the march of dimes. They're in it to make a profit. But when you see them pulling back like this, it's a really good indicator that they're not sure what's going to happen. So they're not willing to risk their capital to put new stock in the ground. And so that building permits were at the lowest level in 5 years. They're still breaking ground on previously permitted properties, but fewer projects are being greenlit. And the decline reflects ongoing affordability challenges, high financing costs, and elevated business expenses. So they're not adding. Builder confidence. This one is an interesting one. Builder confidence really gives us a little bit of a view. By the way, Fight Club rules, we never look at new construction with the existing home sales. We always want to separate those because the way that those two markets operate are very different. However, when we look at new construction, that builder sentiment tells us a lot about what the mood of the building economy is, or what of the housing economy. So you can see over the last 5 years, we hit a low in November of 22. That was when interest rates had shot up September, October, November. And we are actually back down to 30. We're at 31. Last month, we were at 32. Anything above 50, the builders say, hey, we're really optimistic. Anything below 50 is pessimistic. And I will say that's some of the lowest builder confidence I've seen in a long time.
I agree with you on that one. But what do they think is going to happen? What that tells me is that they think that resales are going to start to jump back up again, and they're going to lose their profit margins that they've had so joyously been able to take advantage of these last few years, right? I mean, they're going to, although we should continue construction, there are for-profit companies. They don't want to lose money. And, they've been having these great incentives with interest rates and stuff. And as interest rates start to come back down, they're going to lose that edge, right? Because right now I was dealing with a client this morning and they're offering, 4.875, 5.875, these, really attractive rates. And as soon as those resale market rates contract on that, they lose an edge. They'll always offer incentives for down payment. For closing costs, et cetera. I think that'll always be there. But this rate stuff has only been here for COVID, like since COVID happened, because they had a competitive edge. So, we look at this as, why is their confidence going down? I don't think it's because necessarily the economy is heading in a direction. I just think that their profit margins are going to be impacted. So, hey, let's build a little less because people are going to go out there and be selling all these houses again. And now we're going to lose that traffic that we've been, reeling in these past few years.
Yeah, you got it. And I won't call anyone out on this, but I know there's someone on this call that just was personally in the buying market, and it was because of interest rates and builder incentives. It was way cheaper to buy new construction than it was to buy an existing resale.
Yeah, and that's what they say right now. It's like really an opportune time to be able to purchase a new construction home, and I've been saying it. I read a couple months back. They said October is where it's going to peak for new construction. That should be about where it peaks. Probably be your best month if you're going to do it. Should be in October, and then after that, it's going to be all downhill from there.
Yeah, it's great insight for your buyers. So builders continue cutting prices. We're seeing about 5% nationally. They're increasing incentives, and 66% last month offered deals in August. So the deals are there. It's resilience by the builders using incentives, but there's caution. They're just concerned. So moving to Jerome Powell's Jackson Hole comments. He said risks are tilted two ways. Employment risks are skewed to the downside, labor market's cooling, while the inflation risks remain on the upside with tariff pressures present. It's an imbalanced risk environment that may warrant a policy change. And that was the sentence that moved the market. Of course, as we talked, there wasn't a cut promise, but Powell signaled the Fed's open to September rate cuts. And as I said earlier, the odds right now are sitting at about 85%. And Chris and I, we kind of laughed because there's actually a site you can go place a bet on.
Polymarket. It's called Polymarket.
On what direction rates will go.
I was actually looking at that just before, and let's see what Polymarket's odds are. So September, it says there's a 78% chance that they're going to decrease by 25 basis points, and 5% that will go to 50. And there's $49 million worth of betting volume going through that
That's
trade.
Crazy. That's crazy.
Yeah.
I won't even comment.
Nah.
Here's a couple of other things he said. He said that the two-sided risk, that easing too soon could fuel inflation, while easing too late could harm employment. And the one thing that, even though it looks like we're going to have two rate cuts, the one thing that could happen is we could see another jobs report, and some of those revisions could also be revised. So we could see the August jobs report revised upward, and that would probably take a cut off the table, if I'm being honest.
And so pay attention, because September 5th is the next jobs report that's going to come out at 8:30 a.m. It's next Friday, I believe that is, right?
Yeah.
Next Friday. So that'll be a market mover for sure.
Yeah, for sure. Existing home sales, this is what we care about, because everything that we've talked about up to now, it shows up in these numbers. And this month we did rise to a seasonally adjusted 4.01 million. So we're just shy over 4 million. And when you look at history, We virtually have never gone below 4 million home sales. There was just one little period in the late 70s, early 80s when we dropped below that. And yet 4 million is kind of the bottom. So we're literally dragging across the bottom of the market. So we're seeing a little bit of a rebound, and yet we're starting to see some of the activity taper off this year. Especially, we're headed into a busier time for our season, and yet most of the markets are going to start to head into their fall and winter markets when you see things slow down. So if we look at the existing home sales over the last 5 years, you can kind of see where we were in that crazy run up 21, 22, and you can see where we're just scraping the bottom. I think that chart says a lot. I did update this information this month. I've been working on a couple month old data. So when we look at affordability, so and this is where Chris is spot on with his payment conversation. But if we look at affordability over the last 5 years, like what's happened and how much it costs us to be able to afford a median priced home with elevated interest rates. Is what we really have is an affordability issue. Even though we hear all this stuff of rate lock-in effect and everything else, it's really affordability. So this is the update. In the last 5 years, the average appreciation of US homes has been 49%, the compounded rate. So rates have basically doubled in 5 years. Average wage growth. So how much did our spending power go up in terms of how much the consumer makes per hour or per year? 17.5%. And when you couple that with where interest rates are, when we look at 2021, the principal and interest payments on the prevailing rate at that time on a median priced home, again, prices have gone up 50%. A median priced home was $1,206 a month, principal and interest. 2025 June, we were sitting at 2,326. It's a 92% increase in the payments. Then when you look at how much did earnings go up and how much income does it take to actually qualify for that in 2021, to qualify for that median home, a median family income, they needed to make 85,806. Today, and the qualifying income was 57,888. So how much income did you need to qualify? Of your roughly 86,000, you needed 57,000 to qualify. Today, we're at 111,000. That means it's a 52% increase in net income needed just to qualify for a median priced home. This is where, as rates come down, we'll see the affordability come down and you'll see a lot of people move off the sidelines. Any thoughts on this one, Chris?
Yeah, so I'm looking at the payment as a percentage of the income, that category, right? And it just shows, from the top, it's at 16.9, and at the bottom, it's at 26.5. These numbers are great because they're setting a client up for what they should have in their monthly mortgage payment as it relates to their budget. But the reality of it is we allow up to 50% debt to income ratio, right? So you could go a little bit lower on those numbers, but still it's just fruit in it's all in the pudding, right? It's all in there in the data that, you need to be making more money right now to afford a house. And when we get rates below 6%, I think the number was something like 4 million people would be able to refinance. And then I think there's 1.5 million people that would be able to qualify that wouldn't normally been able to qualify with the current rate situation. So there is a huge impact on where those rates sit for affordability.
Yeah, if we can just get them to inch down, we're setting ourselves up for a fantastic, probably 5 to 7 year run.
I think it's going to happen anyway. We're kind of, when does that start? When's that starting point?
Yeah, exactly. So, all right, let's dive into a little bit of the national, and then we'll look down into our county level across the U.S. and talking about the housing market is a little bit like talking about the weather. It's all local, but we have to know what's happening at the macro to look at the micro. So across the U.S., the median list price for a home is $449. We're still in seller advantage territory. The market action index is 35. And of course, we get this data from Altos Research. And it's important to know that when you see data from like the National Association of Realtors, NAR lumps in new construction that is pending or that is proposed new construction, new construction that's 6-8 months out that you can't really buy and move into in a reasonable amount of time. NAR lumps all that together. Altos tracks every property in the US that's a resale property, and they strip out all the things that you really can't buy. So you get really pure numbers, and you get a really great, we get these numbers every Friday afternoon. So they're up to the moment of the data. So if you were to be making decisions based on like the NAR data, it's not that it's not good data. It's just, it's about 3-4 months old by the time you get it. So that's where our numbers are going to differ a little bit. Across the US, median days on the market, average is 108 with a median of 63 days. And you're currently seeing 42%, so 4 out of 10 are taking a price reduction, with 10% of the inventory being properties that had been on the market previously. Median rents, you can kind of see that chart there. We're at 2,300. You can see where that's been coming down over time. We look at this compared to last month, inventory rose 0.1% in the US. And that is a really key statistic, because the last probably 12 to 14 months, we've been seeing inventory building. And this is the first time we kind of hit the peak a little bit. And I'll show you what this looks like. Let's see, did I have that in here? I've got condos in here. So let me hit the condos first. In US condos, the median list price of a condo is $379,500. 131 days on the market, so a little longer time. 37% of condos in the US have taken a price decrease, and currently across the US, we're still in slight seller's advantage. So we're close to balance, but it's still advantage seller. Florida and Texas are the two markets that are very different and experiencing a completely different story than the rest of the economy is. Condos, actually, inventory for condos actually went down by 2.1% this month. So again, we're starting to see that August, September fade in inventory that we typically would see, but we've not seen the last 3 years. We've been seeing the inventory continue to accelerate, even in that fall period where people start to take properties off the market at other markets. We're not seeing this. So this is a sign that we're getting a little bit back to a healthier, more typical market. When we look at national inventory, historically, we would expect to see somewhere between about 1.2 million and 1.4 million resale single-family homes on the market. Today, we're at 861,000. So we're still, even though it feels like there's a lot of inventory out there, we're still several 100,000 homes less than what we would typically expect to see at any given point on the market. So I think it's important. Now, as rates fall, most buyers, about 80% of buyers, bring a home to the market. And this is where we moved from this savagely unhealthy market of 240,000. You think about that number. The entire United States, there are only 240,000 homes that could be purchased at that time that were existing home sales. That's a
wild.
crazy low. Yeah, that's
Yeah.
just crazy. The challenge with that type of a period, rates fall and inventory is going to fall and your prices are going to shoot up. Now that we're sitting at 800-900, it would be nice to get this a little closer to 1 million. But when rates fall this time, you're going to see inventory actually continue to come on the market, which is good for your buyers, maybe bad for sellers, but you're going to see that inventory continue to climb. And that's what's just so uniquely different. So if there's a silver lining in this pain that we've gone through, it's that the market reset, and now we're positioned for a much healthier market. When we look at average days on the market in the US, 107 days, up from that low in July 2022 of 54 days. Properties with price decreases, you've got currently 42%, so 4 out of 10. Historically, we see about 33-34% taking a price reduction. So prices are still, they're softening in terms of the list price that people are asking. Relisted properties, you can kind of see the little bit of a trend. This trend is usually very seasonal. Obviously, people take homes off the market sometimes at like Thanksgiving or Christmas, and they put it back on in the spring. So we see this number kind of go up and down. But you can see they're keeping their homes on the market if they didn't sell. Median list price, I break this out in the 4 tranches. So the lower 25% and then the upper 25%. And you see the middle. I'm always fascinated that you can see how seasonality plays a role in the upper end of the market in the US and how the rest of the market kind of just follows a very more consistent trend. So let's talk about Florida and see where we are here. Across the entire state, we're actually still an advantage seller. Now, I know that that sounds crazy. It doesn't feel like that, but when it comes to the single family resale market, we're in some semi-balanced territory. Now, there are markets like ours that are probably tilted a little bit more towards the buyer side, and I'll show you what those numbers look like. But across the state, our inventory is building, but we're still in that healthier range. 490,000 is the median list price for a single family resale in the state of Florida. Average days on the market's 133. We've seen 47% taking a price decrease, so about 1 in 2. And we do have our inventory is starting to fall across Florida. We're down to 100,319 inventory. And that number's come down from about 127,000 a few months back. So things are selling. People may still be holding their homes off the market a little bit longer, but we still have a healthy inventory. If we compare this to last month, the inventory is actually down 3.9%. So we're seeing a little bit of seasonality start to creep in. You take a look at the condo market. Obviously, Florida has a disproportionate number of condominiums, and we are an advantage buyer right now. Some of that has to do with the Keystone inspections, which are pushing up association dues a lot. I know mine went from like 600 to like 1,800 in about a 2-year period of time. You've got insurance. There's just some factors there that are keeping that that market a little bit more buyer friendly. The median list price is 342, 175 days on the market, so substantially longer than the national average, even on condos, and 6% relist, so not as high as you see in the national numbers. You'll notice that 2271 of median rent, you can kind of see how that's fallen over this past year, and that's some of the numbers that we're looking at when we see CPI and how it takes that into account. This was interesting. The condo market in Florida was actually flat month over month, so we really didn't see a lot of inventory coming on the market. Now, I've run these numbers a couple times. We've gotten better. This is the good news. If we look at the single family plus condo inventory in Florida, we're sitting at 166,000 units. In the United States, if we add single family and condo together, these are existing homes, we're a little over 1 million. So Florida now is sitting at 15.3% of the total US inventory. We were we were high 20s there for a while, like 27, 28%. And when you added Florida and Texas, those two states had almost 50% of the inventory in the US. So we're moderating a little bit, and this is a good sign because that means that we're not going to see these massive price crashes that everyone's predicting and talking about. We're just not going to see that. So when you see that, know that that's not what the data is actually showing us. There's always doom and gloom people out there. Let's see, we were 15 point. Yeah, this was the previous number. 29.4 was the number a couple months back. So there you go. That's it.
And you brought something that was interesting earlier. You said we have 800,000 or so total, listings for sale. Is that what the number was? And in Florida, I just did some quick searching right now. 1/3 of all occupied homes in Florida are rentals. And in Southwest Florida, 21% of the total housing are second homes. That doesn't include rentals. So in the Southwest Florida market, when rates come back down, there's a lot of investors that are waiting to buy homes here to rent out. There's a lot of people that want second homes that are waiting for the right time. So we may not see as much in our hyper local market of all the inventory coming on with a buy and a sell. I'm not going to say that's not going to happen, but we're going to fight against people that want rental properties for Airbnb and to make money on it, right? And then we're going to have all these vacation people that want to have a second home here that have just been waiting for the right time. I say that because that's going to drive a lot of activity happening. And we went through this in Florida already with the prices going through the roof when rates came back down. Do I think we're going to have that rapid acceleration? No, but I do think we may still see that a little bit of price appreciation as a result of just supply and demand.
Yeah, and it's interesting because we're not really seeing. We all saw the article on I think it was a Cape Coral house that they bought it at this time, and oh my God, it sold for this price, and prices are falling. The reality is we're just seeing the slope of the increase of people thinking, oh, my home is worth 10% more today than it was yesterday. We're just seeing that come back down. So I think we're still going to see percent and a half, 2% appreciation over a 12-month period when we look back. It's prices just aren't falling. It's just they're getting realistic.
Yes, and it all comes down to the reporting too. If the jobs go through the roof and they have to cut rates aggressively, that could spur a lot of demand. I mean, people are just sitting on the sidelines. The right people are sitting on the sidelines waiting for a deal. The right borrower, everybody wants a deal, but the borrowers that need housing should get housing if they need it, because then they could take advantage of lower prices later as in forms of refinances, etc.
Spot on. So let's dive into the local counties. Charlotte, we're still in a little bit of buyer's advantage territory in Charlotte. The median price $399. Median list price, we are 166 days on the market. So we're getting some extended market times for sure. Price decreases, 1 out of 2 properties have taken a price decrease, and we're sitting at about 28.55. We'll show you what that trend looks like. If we look at the condo market, we're also in buyer's advantage. 265 is Charlotte County median list price. We're sitting at 176 days. We're getting closer to 180 days. That's 6 months. This is where you're listing properties in that space. Make sure you're taking long-term listing agreements. It's going to take some time to get there. Price decreases are 37%. 5% have been back on the market. And Charlotte County has 802 in the inventory. So if we just look at the trend, you'll notice you're going to see this trend in all 3 counties. You see where we kind of hit a seasonal high, and now we're kind of starting to come down off that. So we're sitting at 28.55, 7-day moving average for the number of homes for sale up from 282. And Chris, there was a question that Loretta had in the chat. If you'd grab her question.
Sorry. It was for ChatGPT told me that Southwest Florida second homes make up 21% of total housing. Those are just second homes, not rental homes. It didn't have a number for rentals, and it had 35% of all occupied homes in the state of Florida are rentals, and it's pulling that from tax information.
All right, good to know. Charlotte County average days on the market, you can see 165, up from that low of 39. Median list price, you can see we are sitting 399. You can see where that trend is it's staying stable. It's just we came down off that crazy run up that we experienced in 21, 22. We break this down into the tranches. You can see all 4, the lower quadrant, the upper quadrant, all quadrants or all tranches are trending very similar. If anything, you can see the upper end is staying pretty stable, but you can see a little bit of price softening on that median list price on the lower end, which is kind of interesting. We're going to watch that closely over the next couple months. Price decreases, you can see we're starting to come down a little bit. We'd hit some high 50s, almost 60% of properties taking price decreases. And if we break that out, all four tranches, they're following a very similar trend, although the bottom 90 days, the bottom tier is sitting at 56% has taken a reduction, upper is 45. So you can kind of see that. Sarasota, we're still in advantage buyer territory here. Median list price 535. The average days on the market 150, so a little bit better than Charlotte County in terms of time frames. We have 1 out of 2 exactly is taking a price decrease, and the inventory is sitting at 32.25, and you can kind of see where we're starting to fall on that. We look at the condo market, also buyer advantage, slight, not deep buyer territory, but buyer advantage. 399, median list price, average days on the market 141. Not It's not terrible. Charlotte, I think it was 170 something, almost 180. We've got 1,992 existing homes available for sale in Sarasota that are condos. And so when we look at this inventory trend, you can see again, we've kind of we've reached a peak and the inventory is starting to fall. I do believe that we will see this start to trend back up as we move into the end of the year, particularly if interest rates continue to go down. But it's interesting because this is more of a traditional line that we expect to see, and you can kind of notice last few years we just haven't had that. If we look at average days on the market, you can see that we do continue to go up from that low of 37 in 2022. Median list price, you can see where that trend is. We're sitting at 549 versus that 700 that we hit at the high in 2022. Again, the tranches, I put these in here because this helps you in your listing presentations to be able to show a seller or a buyer what's really happening in those markets that they're competing with. Properties with price decreases, you can see as inventory is coming off, fewer of the homes have taken price decreases. So we're sitting at 1 out of 2 right now. And it's pretty consistent. You've got your upper 3 tiers are sitting at 45 to 55, and your lower tiers about 55. So really, it's just that upper 25% of the market that's kind of marching to its own beat in terms of price reductions. We pop up to Manatee County. We are still in a little bit of seller advantage there. So a little more demand, little less inventory. We're sitting at 2508 on inventory. Median list price is 590. Average days on the market 121. So you can see the days on the market is reflecting a little bit more movement. If we look at the condo market, the median price 299, sitting right at 300, with 43% having taken a price reduction and about 1,239 condo units. And we're in slight, that's a single family, that's actually condo, slight buyer territory. So not deep. We just look at those trends. Again, you see inventory starting to peak a little bit. So we're coming over the top of that hump, 2508. Average days on the market, 120. You can see that that's continuing upward, but still less than the other 2 counties south of them. Median list price, 590, holding pretty steady. We don't really see that dipping much. You had a little bit of seasonality, December, January, February, and yet they've come back up. Median list price for the individual pricing tranches here, you've got 379 for the lower 25% and 1.4 for the upper. So that kind of tells you a little bit of where that luxury market is at. We look at Manatee County price decreases. Again, we're starting to, because there's less inventory, you've got a little bit of less percentage of those homes that have taken a price reduction, and pretty similar trend that we see across the other 3 counties there. So let me land this and give you just a couple of local statistics. I did update these again, and this was something that I believe it was Wayne Diller had asked me about that caused some of this to be put in here. This is a moneymaker slide for you guys. Right now, I took all of the data. This did come from Broker Metrics. So this was all of the data. This included all resales of any type. So didn't matter if it was a rental, didn't matter if it was a single family house that was lived in, a private residence. In July, if you price a home right, the average days that it was taking to get an offer was 26 days. They were getting 94.1% of their original price. So price it right, it's still selling. Price it wrong, and you end up on the other side of this quadrant. The average for a home that had 1 or more price reductions took 124 days to sell. and sold at 83.9% of the original price. Now, I don't know about you, but I'd rather have a listing go away in 26 days than live with that thing for 4.5 months. And so I would really take this and make sure you put this in your listing presentations. And this is also helpful for buyers because it gives you some indication if something's been on the market a while, you can look at that and say, well, here's on average where things are selling at. So this is the dreaded let's start high and come down conversation script for you. They want to start high, you can say, I understand wanting to start high, but the numbers from July show us that homes that were priced right sold in 26 days for 94% of their list price. If they overpriced, it was 124 days and 84%. So when you overshoot, you don't actually net more, you lose time, you lose money, and the best buyers see your home in the first 2 to 3 weeks. So if we miss them, your home sits, looks stale, and attracts bargain hunters. If your goal is to maximize what you walk away with, the smart play is to price it right up front, get strong early offers, and negotiate from strength, not after months on the market. For buyers, as a buyer, you finally have choices again. Last year, it was nothing but bidding wars. Today is you can shop, you can negotiate, and you can even ask for concessions. A 2-1 buy down is a great concession to be asking sellers for so that you can get you'd have an interest rate of like 4.5 your first year on a 2-1. Rates feel high, but prices are softer and sellers are negotiating. That means your total monthly payment might be better than you think. When rates come down, you'll have the chance to refinance to a lower payment. So a little bit of talking points for you. A couple more. Waiting on the sideline means paying rent while prices stabilize. Buying now gets you to the market so you can start building equity instead of sitting on it. I've got a couple of other scripts in there for you guys to be able to use. I'd recommend you go take a look. I won't read all these to you for the sake of time because I know we're a little over our time. So we'll put those in there. And with that, that gives us our state of the market for August. I trust that you guys had this was valuable. Wayne, it looks like you raised your hand, buddy. You want to come off mute?
Yeah, a great report as always, Brian. Good job, Chris. That page that you have, that's the moneymaker. And the thing that makes that even stronger, there's a direct correlation between the days on market and the price. What I'm seeing in the last 6 months, single family home for all 3 counties, that median sell price is actually about the same, hardly moved at all. What's happened is that original list price has been lowered. Again, back to your point, if they know what they're doing, pricing it now, they're lowering that price to be in the market we're in and the market we're going to go into. If they're setting on the market, they're in the market that was. So that's the distinct difference. But ironically, the average sell price has not changed, even though the original list price has come down.
Yep, that's awesome. And I think this is where us being the local economists of choice matters because our consumers are seeing these articles. I see them every day that prices are falling and we're going to be at 2008 and all this crazy doom and gloom stuff. We're not there. The homeowner's balance sheet's better. We don't have, it's not a job loss event like what we had in 2008. We're in a very, very different position. And that's why we're not going to see those prices go backwards crazy. Could we go backwards a percentage or two? Yeah, we could for a short period of time, but we're going to stay stable. So great. It's why knowing your numbers matter. So good job, Wayne. Well, good. With that said, I'm about 10 minutes over, so I will let you guys get back to your day. I'll send out the recording with this along with all of the resources. And if you have questions, if there's something that you want covered on a future call, don't hesitate. And Chris is here to help your buyers. If you have people looking, you can send that through the Fast Track app that allows that consumer to get plugged into Chris, that gives them a free soft credit pull. So keep that in mind as you're at open houses and just when you're working with folks, or if you've got people in your database that are looking to refinance, that's a great tool to just say, hey, if you want to be prepared, let's get you in the queue because when rates drop, there's a flurry of activity and we don't want you to miss out on rates that would be good for a refinance. So we're here for you for anything that you need. Go do what you do best, list and sell and represent your clients. And we will see you next month for the next call.
Thanks to y'all. Have a great day.
Thanks, everybody.